Okay, this is for the third week, Tuesday class. So during the first 2 weeks, we were basically on schedule. We finished the chapter on equity. And now we could talk about the fixed income chapter. When we're talking about fixed income, we're basically indicating two kinds of markets. The first one is the money market, and the second one is the bond market. The money market is basically a market for liquid, low risk debt with maturities 1 year or less than 1 year. In this class, due to the limit on our time, I will basically put this part as optional. So you can see that this whole section is optional. And if you're interested, you can read the textbook. And another thing is, as a retail investor, you can actually invest in money market fund. Generally, your broker will offer a lot of choices in money market funds. It's generally low risk, sort of like your savings account. So anyway, I will just skip this part. So let's go straight into the bond market. Bond market is composed of longer term borrowing or debt, and in reality, bonds are generally traded OTC. So here, OTC refers to over the counter. However, you could also buy bonds directly, right, as a retail investor. But generally, more often, you will actually buy mutual funds or ETFs, which holds a portfolio of bonds. Now, there are two very basic concepts about bonds. The first one is about face value or par value, which is basically the principal repaid at maturity. So think about this. If you buy a bond with a par value of 1,000, it basically means that when the time comes, that is on this maturity date, you will get paid $1,000. And then a very important concept is coupon rate. Why it is important? Well, because your interest payment determines on the coupon rate. So to be more specific, the annual interest payment equals coupon rate times par value. A lot of bonds, they make their coupon payments twice per year. So it's semi-annually. Now let's talk about several different kinds of bonds. Canada bonds. Well, Canada bonds is really this bonds issued by Canadian government. It has this maturity generally between 1 year to 30 years, and the par value is $1,000. Coupon payments twice per year in March and September. When you're looking at the quote, Canada bonds are quoted in the percentage of par value. So now let's read this table and see what we could learn from these different columns, right? So let's say we focus on this 5-year bond, right? So here you can see that it has 4 columns: coupon rate, maturity date, price, and yield. Coupon rate is obvious, right? And effective maturity date, it basically means that, let's say for the second bond, so on the date of September 1st, 2017, you will get back your money. The price, right? Price is a percentage quote. Basically, it means that if the par value is 1,000, then to buy one bond, you have to pay this number, right? That is, you have to pay $1,010.02, right? Now yield, we have not talked about yield yet. It's a very important bound feature, and we will talk about it. Another thing, if you're curious, you can see that for all these four bonds, right, their price is quoted larger than 100%. So basically, you could see that for the second bond, even its par value is 1,000, you have to pay a premium bond. You have to pay a premium to buy the bond. To be more specific, you have to spend $10 more than the par value. That's interesting, right? If par value is 1,000, why would you pay more? Well, the reason is because if you compare the coupon rate and the yield. So here you can see that yield is basically the interest rate, and coupon rate is actually higher than the yield. In this case, it means that you're getting a lot of payments from this annual coupon payments. And a basic law of bond pricing is whenever coupon rate is larger than yield, then this bond will become a premium bond. That is, the price is larger than par value. And you could also compare this 5-year bond to the 2-year bond. You can see that, so this is the 2-year bond, right? You can see that the interesting result is here the coupon rate is actually smaller compared with the yield. And in this case, for $1,000 of par value, you would only pay 99.9%, right? So basically, it's a discount bond. Again, in this case, you will learn about this. That is, if the coupon rate is lower compared with the yield, then this bond will become a discount bond. Another important caveat about this coupon rate, this coupon interest payment is how do you exactly calculate this annual coupon payment? So here, you can see that the coupon rate is 1.5%, and the par value is 1,000. So you can see that annually, every year, you will get 1,000 times 1.5%. So every year you will get $15. And because you get paid twice per year, so per payment is $7.5. This is the first caveat. Obviously, you need to learn how to calculate the semi-annual payments. And later you will see that this actually has very important implications on bond pricing. Okay, the second type of bond we're talking about is the inflation-protected treasury bonds. It is inflation-protected because basically there is some indexing happening here. Means that if you have a $1,000 principal, right, or par value, let's say suddenly you find out the inflation rate is 1% higher than expected. In this case, your par value, your bond par value will be raised by additional 1%. Quickly, you will see an example which tells you exactly how this inflation-protected treasury bonds work. There are basically two kinds of inflation-protected bonds in Canada and in the U.S. In Canada, it's called real return bonds, And in the US, it's called Treasury Inflation Protected Securities, short for the short name is TIPS. And then there are also these provincial bonds in Canada. So basically, these are bonds issued by provincial government or provincial crown corporations. Now, let's see this example on TIPS. Now, consider a newly issued bond with a 3-year maturity, par value of 1,000, and a coupon rate of 4%. We assume the bond makes annual coupon payments. So here we are trying to make things simple, right? So we're not consider the more realistic of semi-annual coupon payments. We're just thinking, okay, this bond will pay me interest once per year. Right? We assume that inflation turns out to be 2%, 3%, and 1% in the next 3 years. Now we have 3 questions. First, what are the cash flows paid by the bonds? Second, what is the first year nominal rate of return? Third, what is the first year real rate of return? So first, let's think about the cash flows. Okay. Now let me start from the first year. Right? So the first year, second year, third year. So we are thinking about cash flows. Now, think about what kind of cash flows you will get if you hold a bond, right? So basically, in the first year, you will get your coupon payment, right? You will get your coupon payment. And in the second year, you will continue to receive your coupon payment. And in the third year, you will get coupon payment plus what? Well, plus the par value, right? You will get back your principal. Now, obviously, coupon payment equals coupon rate times principal, right? We know this. So we know we should use coupon rate times par value, right? Now, we could see that the coupon rate is 3%. Oops, the coupon rate is 4%. So we could use 4% here. So 4%. Now, what is the par value, right? If we go back to the definition of, inflation-protected bonds, we can see that principal will be adjusted in proportion to consumer price index. Right? So basically, as I said, you will modify the principal according to the inflation rate. So previously, on the starting date, the par value was $1,000. And we know that for the first year, the inflation is 2%. So basically, par value has to be adjusted upward, right? 1 plus 2%. That's the par value here. So basically, I guess the coupon payment is, let me copy from the lecture. So it's 40.80. Now, for the second year, 4% times par value. Right? Now we have to make further adjustment because we know that the second year, the inflation rate is 3%. So we times 1 plus 3%. Now this gives us 42.02. Now for the third year, we have 2 streams of cash flows. The first one is coupon payment. So it's 4% times 1,000 1 plus 2%, 1 plus 3%, and then we have to consider the third year's 1% inflation. So this gives us 42.44. 42.44. Now, what is the par value? Well, par value is easy, right? Because this is essentially our par value here. So par value is given by 1,000 times 1 plus 2%, 1 plus 3%, 1 plus 1%, which is so this number. So it's 1061.11. Now, these are our cash flows, right? This is the first year's cash flow, second year's cash flow, the third year's cash flow, right? These are our cash flows. Okay, great. Now let's see the first year nominal rate of return, right? So how do you calculate your first year's rate of return? Well, we have done some calculation here. You can see that the first year, this is what we get, right? So you can see that to solve the second question, we could find out the first year return equals this divided by what? Well, you will divide this number with 1,000. That is your initial par value. Next, let's think about this. Is this the correct answer? Well, you can see that it is not, because on this initial date, the price was $1,000, right? And then in the first year, the par value or the principal increases to what? Increases to 1,000 times 1 plus 2%, right? So clearly, you have to consider this. Oops. So you have to consider the appreciation in the par value of your bond, right? Okay, that's great. Let's see what is the answer here. Okay, so it's 6.8%. Now you can see that supposedly your coupon rate is 4%. However, because of the adjustment in the par value, your first year nominal rate of return is actually larger than your coupon rate, right? However, this is just your nominal rate of return, because you can see that in this case, your return contains inflation, right? So now let's think about how could we calculate the real rate of return, right? A simple formula about calculating real return is 1 plus real return times 1 plus inflation equals 1 plus nominal return. If you have taken macroeconomics, then you should be able to understand this. But if you haven't taken your macroeconomics, you could just memorize this formula. So here you can see that the real return equals 1 plus nominal rate divided by 1 plus inflation. The first year's inflation, right? So what is the first year's inflation? It's 2% minus 1. And this basically gives us 4%. So this is interesting, right? So it basically shows you that even there was 2% inflation, even the nominal rate of return ended up higher than 4%. But because of this whole design in this bond, which offsets inflation, in the end, the real rate of return keeps the same. It's still 4%, right? So that's why this is inflation protected bond. Right? You can see that no matter what was this inflation, in the end, your real rate of return is always 4%. Okay. There are also this municipal bonds, right? Or munis. These are bonds issued by a city or a county. Generally, they offer higher returns compared with Canada bonds or provincial bonds. The reason is because if a bond is just backed up, the reason is because if a bond is just backed by a city, then generally it has higher risk. So investors, they demand higher returns. In Canada, your interest returns or the interest payments you receive from municipal bonds are fully taxable. This is different from the US. In the US, let's say if you live in Arizona and if you buy Arizona bonds, right? In this case, interest payments from the Arizona bonds are fully tax free if you're a Arizona resident. So there are different taxes about munis in Canada and in the US. There are also different types of municipal bonds. So the first one is called general obligation bonds. It is backed by taxing power of the city. Then there's also this revenue bonds. It is backed by the project's revenue or by this agency which is operating the project. So generally, I would say this general obligation bond, they have lower risk compared with the revenue bond. Okay, now we talk about corporate bonds. These are important types of bond. So corporate bonds, they're issued obviously by firms. They make semi-annual interest payments, and they have larger default risk than government bonds. So you can imagine that generally corporate bonds, they have higher returns because of higher default risk. Why do you think corporate bonds have larger default risk? Why? Well, I would say that if you think about government bonds, right? These bonds are issued by government, and governments, they have taxing powers. So if they have any difficulty in meeting their debt obligations, a government can generally raise tax to pay back debt holders, right? This is different in the case of corporate bonds. Corporate firms, they don't have taxing powers. They could only use their revenue, their earnings, right? They could only use these things to pay back their debt. So corporate bonds are riskier. Corporate bonds could be quite complicated. Generally, for a lot of bonds, they have options. I know I have not talked about options. So here, I'm just gonna mention these different types of embedded options in corporate bonds. So we don't want to talk too much about these options. Actually, I think we will talk about options in corporate bonds in the third part. That is when we're actually talking about options. So here, let's just introduce, right? Make some introductions. Um, there are this so-called callable bonds. So it basically means that the firm, it has an option to repurchase these bonds before the maturity date. What this means is, let's say a corporate bond has a maturity date of 2022 December 31. However, if it is a callable bonds, then this issuing firm can actually tell those debt holders, hey, I wanted to buy back these bonds on 2021, exactly 1 year before this maturity date. So if this is a callable bond, then this issuing firm can do this. Then there are also very popular convertible bonds. Judging from the name, you can see that these bonds can be converted into firms' equity. Then the third type is puttable bond. It means that if you're the debt holder, right, then you have the option to retire or extend the bond. And then there are also this floating rate bonds. It basically means it has an adjustable coupon rate. You can imagine that possibly this firm could tie this corporate bonds coupon rate to a certain interest rate, right? So if this market interest rate changes, then this coupon rate could change. I actually have preferred stock here. Okay, I think I would make this optional because supposedly preferred stock should be in the last chapter, in the equity chapter. I guess I made some mistake and put this preferred stock in this bond chapter. So let's just skip this page. And again, this one is optional. Okay, international bond. So there are two major kinds of international bonds. The first is Euro bond. The second is foreign bond. So first, what is a Euro bond? It's a bond denominated in a currency other than the home currency of the country or market in which it is issued. For example, we could talk about Euro dollar bond. So it is a USD denominated bond sold outside the US. Then there's also this Euro yen bond and Euro sterling bond. Now, what is a foreign bond? It is a bond which is issued in a domestic market by a foreign firm in the domestic market's currency. For example, in the Canadian context, we could talk about maple bonds. It's a type of bond which is denominated in Canadian dollars, sold in Canada. However, it's by a non-Canadian issuer. So let me give you several examples to make these two definitions easy to understand. So let's say you're a Canadian investor, right? So you're a Canadian investor. You're a Canadian investor. So let's say you're thinking about or you're trying to buy 3 different kinds of bond. The first one is, let's say it's a Canadian bond, right? Issued by Air Canada. And then the second one is, let's say it's a USD bond by let's say by Facebook. And then the third kind of bond is the Canadian bond by Facebook. Right. Now, for the first bond, that is bond in Canadian dollars issued by Air Canada. This is a domestic bond. So it's a domestic bond. And then for the second type of bond and third type of bond, they both are international bonds. Now let's look at the second type of bond. It's a bond denominated in US dollars issued by Facebook. So Facebook is a US firm. And in this case, right? In this case, it's a euro bond. It's a euro bond. Well, because it is a USD denominated bond sold outside the US, right? Okay. What about the third bond? Well, this is easy to understand, right? It's a Canadian bond issued by Facebook. So basically, it's a bond denominated in the home country currency. However, it is issued by a foreign firm. So this is a foreign bond. Basically, the purpose of talking about different kinds of bonds is to give you some common sense, right? I can tell you that I will not test you in the exam asking you whether this bond is a euro bond or a foreign bond. So this slide is just for common sense purpose. Okay, now let's talk about asset-backed bonds. It's actually a derivative type of security. So basically, the income from a specified type of assets is used to service the debt. The most conventional asset-backed securities are MBS, that is mortgage-backed securities. I want to talk about this because MBS was actually quite famous, I would say, in financial crisis, because during 2008, this whole financial crisis was partially attributed to the meltdown in this MBS market because of this housing crisis during 2008. Okay, let's talk about MBS, right? Well, what are these mortgage-backed securities about? So this is how MBS was constructed. So basically, you will bundle, right, mortgages from different households into a mortgage pool, right? So it's like a portfolio of mortgages. Oops. Now you have this mortgage pool here. And then you actually look at this mortgage pool and you will actually try to separate or divide this mortgage pool into different parts according to risks. For example, you have this unsecured part, this medium risk part, this secured part. To be more specific, it basically means that you could separate this mortgage pool into 3 different types of risks, right? So this is basically high risk. The second one is medium risk. And the third one is low risk. Well, the first one is high risk because it's unsecured. And then the third one is low risk because it's security. And then you can see that if it is unsecured, investors, they demand high returns, right? So you're getting 12% return. And then if it is secured, then investor will demand lower return because its risk is lower. So it's a 7% return. In Canada, MBSs are generally lower risk compared with MBSs in the US. The reason is because MBSs in Canada are guaranteed by by federal government under this National Housing Act. And in the US, part of MBSs are guaranteed by these US agencies, Fannie Mae and Freddie Mac. However, in the US, a large portion of MBSs are not guaranteed because they are issued by private firms. And you can see that here you can see this time series changes in mortgage-backed securities in the US. And then you can see that this portion is guaranteed by federal agencies. But this portion, they are by private issuers. And one thing you could also see that the issue of MBSs reached their peak right before 2008, right? And then after this 2008 crisis, you can see that MBSs became less popular. Okay, now let's talk about bond pricing. So, well, most likely you guys have learned about this in corporate finance too. So bond price is this discounted value of coupon payments and par value, right? Again, just think about the general framework of calculating present value. When you're calculating present value, you would think about two things: cash flows and discount factor, right? So here, you're essentially calculating the present value of the bond, which is the bond price. And you will look at two sets of cash flows. The first set is coupon payments. The second set is this par value, or your principal. And then you would discount coupon payments, and you would also discount the par value. To understand this formula, you could see that coupon payments is essentially a T-period annuity, right? Because you are getting this coupon, let's say it's annual payment, and then you will get this every year. Then if this bond has a 30-year maturity, so you will get 30 years of coupon payments. It's just like a 30-year annuity. And then on the final date, you will get back your par value. So you will just discount this par value by 1 plus discount factor, exponential t here, right? So it's actually pretty easy to understand how you would use this formula to price a bond. So R here is basically interest rate, right? To be more precise, it's the yield. Of course, we have not talked about yield yet. Let's just call this as interest rate. Oops. And we also call this part as annuity factor, right? So this part is called annuity factor. And then this part is called present value factor. It's not super important, I mean, it's just a name, but the textbook likes to use annuity factor and present value factor. So it could be useful. If you could, re, if you could, if you could remember these. I mean, the first part is called an annuity factor, and the second part is called PV factor. Okay, let's see a example and learn how to use this formula to calculate the price of bonds. I would say this formula looks very straightforward, very simple, but there are caveats and you have to be careful with this. Now let's look at this example here. So we have basically a 30-year maturity bond with 8% coupon rate and $1,000 per value. Let's say the market rate of interest is 8%. Now we want to calculate what is this bond price, right? Very easy, right? I mean, at least it's very easy. What you need to do here, you would basically want to plug in coupon payments, interest rate, and par value, right? That's it. But you have to consider the case of semi-annual payment, right? This is actually important. So it's semi-annual payments, right? Well, if your coupon payment is paid twice per year, this implies that a 30-year maturity bond will give you 60 coupon payment, right? So this basically means for this T, right, you have to use 60 here instead of 30. So basically you can see that the capital T here does not necessarily indicates number of years. More precisely, T actually refers to number of coupon payments, right? So this is the caveat here, and clearly you have to be careful with this. Okay, so now we know there are 60 coupon payments. However, if coupon is paid twice per year and the annual interest rate is 8%, then this implies the 6-month interest rate is 4%, right? So we have to adjust the discount factor from 8% to 4%, right? So here, if you look at this formula, you could see these adjustments. Oops. So this is the first adjustment, right? You have 60 periods. And this is the second adjustment. Right? So you have this 6-month 4% interest rate as the discount factor. In the second case, if the market interest rate is 10%, you can see that again, 60 periods, 5% discount factor. If you compare these two cases, you can see that if market interest rate is 8%, then the bond price is $1,000. If market interest rate is 10%, then the bond price is $810. So you can see that the relationship between bond price and interest rate is if interest rate increases, the bond price decreases. In the near future, we'll talk about this in a more detailed way, but here it's useful to remember this. At least this is the result we can get from this very simple example. Okay. So this is basically a graphic representation of the previous result. It shows you that at the interest rate of 8, we have $1,000 as the bond price. If interest rate increases, right, from 8 to 10%, we have this lower value, which is $810 as the bond price. So now we will basically start talking about the relationship between bond price and yields. Right. Again, here, just consider yields as interest rate. Now, let's see what we can get from this picture here. We could get 3 results from this picture. The first result we can get is interest rate increases, bond price decreases. Right? And what's the second one? Well, the second one is, you can see that this curve here is convex. That is, the curve is convex. I guess you need some basic mathematical understanding about convexity and concavity. If you're thinking about the curves, right? Okay, let me draw 2 curves. So this one is convex curve. This one is concave curve. Now, what's interesting about this convex curve? Right? Well, you can actually see this. You can see that because of this convexity, if let me give you, let's say, if interest rate goes from 2 to 4, where's 4 here? I guess this is 4. Now you can see that the bond price decreases by a large amount, right? But if interest rate is 8, now if you increase this by 2, that is, you go from 8 to 10, then you can see that the bond price only decreases a little bit, right? So this basically tells you that the sensitivity of bond price to interest rate decreases as interest rate decreases, right? Okay, I made a mistake. The correct statement is the sensitivity of bond price to interest rate decreases as interest rate increases. Or following from the lecture note, which is actually a better statement. So bond price becomes less sensitive to interest as interest rate grows higher. Now, what's the third observation? Our third observation is about the premium bond and the discount bond. Now, if we look at different level of interest rate, let's say I look at 1 and 10. So at interest rate of 10, the bond price is $810. And then at the interest rate of 1, the bond price is about, I would say, $2,700, right? Now you can see that depending on the interest rate, you can see that the bond price could be actually higher than the par value or lower than the par value, right? So basically you can see that if interest rate is 1%, then you can see that the bond price is larger compared with par value. So in this case, this is a premium bond, right? So here, the word premium basically means that its price is larger than the par value. Now, if R equals 10%, then it's a discount bond. Here, the word discount basically means par value is actually larger than the bond price. Now, if you recall, right? If you recall, the coupon rate is 8%. So, why do you get a premium bond? Well, in this case, the interest rate equals 1%. You're getting a premium bond because the interest rate is smaller compared with the coupon rate. That is, whenever coupon rate is higher than interest rate, this bond will become a premium bond. And whenever coupon rate is actually lower compared with the interest rate, then you will have a discount bond. So let me repeat the second observation. That is, a bond can be a premium or discount bond depending on whether coupon rate is higher or lower than interest rate. And you can imagine that this is actually a very intuitive result. For example, the bond will become a premium bond if coupon rate is higher compared with interest rate. This is easy to understand, right? Because if coupon rate is higher than interest rate, it means that as a bondholder, you're getting an abnormally high return from the coupon payments, which means that you will have to pay a premium in bond price to buy the bond. So the bond price will become above the par value. Okay, now let's see a table or a very simple calculation which tells you how bond prices and interest rates, they are related at different maturities. So here you can see that we have 4 different kinds of maturities, right? We have 1 year, 10 years, 20 years, and 30 years, from very short maturity to very long maturity. And then we have these, let's see, we have these 5 different interest rate, right? Now let's assume the coupon rate is 8% and the coupon payments are paid semi-annually. Now, if you're given these data, right, if you're having the time to maturity, if you have the interest rate, if you have the coupon rate, if you know it's semi-annual coupon payments, then use this formula. Use this bond pricing formula. You should be able to calculate all these numbers in this table, right? All these numbers in this table. Of course, now our focus is not about these numbers or how we could get these numbers. Our focus here is we want to see how bond price would change with yields when we have different maturities. Okay, so, okay, now let me first remove these marks. Okay, now let's just observe. Let's say we look at 8%. Okay, let's look at 2% and 4%. So let's say interest rate increases from 2% to 4%. In this case, we know that bond price should decrease, right? You can see that for all these bonds, for all these 4 different bonds, bond price decreases, right? Now, if you think about, or if you compare these two numbers, you can see that the difference is about 20, right? And if you think about the percentage, it's about 2%. So this basically means that for this 1 year maturity bond, if interest rate increases from 2% to 4%, then bond price decreases by about 2%. Right? Now let's look at the 30-year bond. If you compare these two numbers, you can see that the difference is almost, I would say, it's almost $600, right? And in this case, you can see that if you use $600 and as the numerator, and then you would use the $2,348 as the denominator, then you could calculate the difference is about so 600. Okay, let me use this. So the original price minus the new price divided by the original price. I don't know. I think it's about potentially 25%. Okay, let's say it's 20%. It might be 25 or 24%. But the key here is you can see that for this 30-year maturity bond, if interest rate increases from 2% to 4%, then the bond price will decrease by 20%, right? Obviously, for the same changes in the interest rate, the decrease in bond price is much larger for this 30-year bond. So what's the lesson here? Well, the lesson here is bond price is more sensitive to changes in market interest rates if bonds maturity is higher. Okay, now let's summarize. So bond price is less sensitive to interest rate if its yield is higher, its maturity is shorter, right? So in this case, it basically means that high yield short-term bond has a smaller interest risk. Okay, let me explain here. First, bond price is less sensitive to rising interest rate. So why do you care about this, right? Why do you care about rising interest rate? Well, because we just learned bond price decreases if interest rate increases. If you're a debt holder, if you invest in bond, you do care about whether interest rate rises, right? Because if interest rate rises, it means the value of the value of your bond decreases, so you will suffer from this investment loss, right? This is obviously a risk to you. This is called interest rate risk. That is, if interest rate increases as a bond holder, your investment would suffer because bond price would decrease. So this is the interest rate risk. Okay, now, as a bond holder, you do want to mitigate interest risk, right? Now, in this case, you want to think what type of bond would give you lower interest rate risk. And we have learned about this, right? We know that if it's a short-term bond, or if the maturity is shorter, then the bond price is less sensitive to rising interest rate. Again, we got this result from this table. That is, we find out for this 1 year bond, its bond price only decreases by 2%, but for the 30-year one, it decreases by 20%. So as an investor, at least from the perspective of interest rate risk, you're much better if you're holding this 1-year bond. Okay. Now, there is also the second result, right? Because it says that bond price is less sensitive to rising interest rate if its yield is higher. Now, how could we get this result? Well, because we have learned about this in this picture, right? We learned that if you're at this 8% yield, now, if the yield increases from 8 to 10%, the bond price only decreases by a little bit, right? However, if it increases from 1 to 3, right, it's the same 2% increases, but the bond price decreases a lot. So as a bond investor, as a bond holder, right, you will be better off if you're at the 8% yield, because in that case, even interest rate rises, your investment will just suffer a little bit, right? So that's why you're getting this result. Bond price less sensitive to rising interest rate if the yield is higher. This basically implies that if you care about, you should. If you care about interest risk, then you would know that high yield short-term bond has a smaller interest risk. This basically means that if you're expecting interest rate will rise in the future, for example, if Bank of Canada is increasing its benchmark rate, then you would know that interest rate will be higher. And if you expect Bank of Canada to do so in the future, then maybe you should adjust your investment. Maybe you would want to invest in high yield short-term bond. Okay, now let's look at bond price and coupon payments. So here we are basically examining what factors could affect bond price. Again, why do you care about bond price? Because, well, if you're a bond holder, your investment value is tied to bond prices. If bond prices increase, then you will be happy. If bond price decreases, then you would suffer, right? Okay. So a convention in the bond market is the quoted bond price does not include interest. This is important in actual transaction because you can imagine that coupon payments are just made semi-annually. So think about it. If coupon payments are in March and September, then if you're buying bond in June, then the bond price has to reflect this sort of 50% coupon payments, right? So let's see how this adjustment works. So basically, if a bond is bought between coupon payments, the buyer must pay the seller for the accrued interest, which is the prorated share of the upcoming semi-annual coupon. So here you can see that the calculation here is actually pretty easy. So basically, accrued interest equals semi-annual coupon times days since last coupon payment divided by days separating coupon payments. Again, this is a simple formula, but it's not that clear what does days separating coupon payments mean here. Again, you will see an example which will clarify these things. So bond price would be, the actual sale or the invoice price would be the stated or quoted price plus the accrued interest. So now let's do this simple calculation and see how could we calculate the accrued interest and how could we calculate the invoice or the actual sale price. Okay, so let's say the coupon rate is 8% and the par value is $1,000. If 30 days have passed since the last payment, and there are 182 days in the semi-annual coupon period. First, what is the accrued interest? Second, if the quoted price of the bond is $990, what is the actual sale price? So first, accrued interest, right? Oops. Accrued interest. So what's the semi-annual coupon payment? We know that the coupon rate is 8% and par value is 1,000. So the annual payment should be 80%. Should be $80. And then because it's semi-annual, so the per period coupon payment would be $40. And then we're calculating the prorated amount. And we know that days separating the coupon payments are given by 182 days. And 30 days have passed, right? So this gives us the accrued interest rates, which is 6.59. And if the bond price or the quote price is 990, then as a buyer, we have to compensate sellers for this amount. So the invoice price equals 990 plus the accrued interest payments, which gives us $996.59. Okay, now let's consider how bond price change over time. Okay, I'll first state the result. Then I will give you the intuition. Why do you get these results? So first, for premium bond, as the bond approaches maturity, then premium bond will fall in value. That is, the bond price will decrease. Now, for discount bond, as the bond approaches maturity, the discount price will actually increase. Okay, now, if you look at this picture, it basically tells you the result we just talked about. Now, we have a yield of 8%. And here you can see that you have a coupon rate of 12%. So it's larger than 8%, which means this is a premium bond. Right? And 4% is smaller than 8% of the yield. So this is a discount bond. Now, what is the par value here? We're just having the percentage of par value. So this gives us the par value. Now you can see that this is the discount bond. And this is the premium bond. And the result we just stated was for premium bond, as the bond approaches maturity, right? So it goes from the left to the right, then this means it approaches maturity. Now we could see that the price of the bond would just decrease, right? And in the end, it will just converges to the par value. So this is the par value. And for the discount bond, it will increases to the par value. This is very natural, right? So the first method to understand this is you could see that on this maturity date, all bonds will have a par value. The bond price of any bond will equal to par value on the maturity date. So a convergence will definitely happen. This implies that if the initial bond price was higher than par value, then the bond price has to decrease. That's the only way the bond price can converge to par value. So the same logic applies to discount bond. If a bond, its initial price was lower compared with par value, then because we know that in the end, the bond price will have to converge to par value, then the only way for this convergence is the bond price will increase to par value, right? So this is a very easy to understand and it's a very natural result. And the second method or the second type of intuition is given by the lecture note. So think about why a bond would become a premium bond. Well, it's because its coupon rate is higher than its yield, or it's higher than the interest rate. So as the investor, right, you would get this higher than normal coupon payments before the maturity date. That's why you would want to pay a premium for the bond. However, as the premium bond approaches maturity, then there are fewer and fewer of these above market coupon payments remain. So the premium bond becomes less valuable, so its price will decrease. Now the same logic applies to discount bond, right? Why it's a discount bond? Because the coupon rate is lower compared with the interest rate, which means that as this investor, you would suffer initially because the coupon payment rate or the coupon rate was below the market rate, right? You were not happy. So you will ask for some discount in the bond price. But as time goes, as the bond approaches maturity, then fewer and fewer of these below market rate coupon payments remain. So this implies that the bond price should increase as the bond approaches maturity. Okay, that's for today's class.